Welcome to StockTok's deep dive into Nike Inc. Nike is the world's largest designer and marketer of athletic footwear, apparel, and equipment, selling its products across more than 190 countries. At the time of recording, the stock is trading at $46.03, sitting near the lower end of its 52-week range of $42.09 to $80.17. The 50-day moving average stands at $54.92, well above the current price, and the 200-day moving average is at $64.79, meaning the stock is trading below both key trend indicators, a structurally bearish technical setup in our view. The 14-day RSI, a momentum oscillator that measures buying and selling pressure on a scale of 0 to 100, reads 38.8, approaching oversold territory but not yet signaling a confirmed reversal. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Nike's core revenue engine is its direct-to-consumer and wholesale channels, where it monetizes one of the most powerful brand intangibles in global consumer goods, the swoosh. Its competitive moat rests on brand equity, athlete endorsements, and a proprietary product pipeline. The StockTok score for Nike Inc. comes in at 34 out of 100, which falls into our avoid signal. Breaking that down, valuation scores 6 out of 20, financial health 10 out of 20, profitability 7 out of 20, growth a very weak 3 out of 20, and smart money 8 out of 20. The composite picture reflects a business under meaningful fundamental pressure. Now, valuation. The question every investor has to answer: are you paying the right price? Nike's trailing price-to-earnings ratio, the price you pay for each dollar of past earnings, sits at 30.48 times. That is not inexpensive for a business posting the growth profile we will discuss shortly. The forward price-to-earnings ratio, based on next year's estimated earnings, compresses to 24.47 times, which reflects a street expectation of an earnings recovery. But here is where the setup gets complicated. The PEG ratio, which adjusts the price-to-earnings multiple for the growth rate, where a reading of 1 is considered fair value, stands at 21.77. That is an extreme reading, implying the market is still pricing in a growth story that the recent data has not yet validated. The enterprise value to EBITDA multiple, a capital structure neutral valuation measure, is 19.81 times. In terms of economic moat, in our view, Nike possesses genuine intangible asset strength through global brand recognition and athlete partnerships. But pricing power has come under pressure from both competition and inventory dynamics. The Guru Focus Value, an intrinsic value estimate based on historical multiples and growth, sits at $75.10 at the time of recording, against a current price of $46.03, implying a margin of safety of 38.71%, meaning the stock trades at a meaningful discount to that model estimate. Wall Street analysts at the time of recording have a consensus mean target of $62 across 33 analysts, with a high target of $120 and a low of $23, an unusually wide dispersion that reflects genuine uncertainty. The next earnings report is due June 25, 2026, with the street expecting earnings per share of approximately 0.12, a narrow range between 0.05 and 0.18, making it a meaningful near-term catalyst to watch. Market sentiment around Nike Inc., as of the creation of this video, leans neutral, with a sentiment score of 0.00 on a -1 to +1 scale, essentially no directional conviction in recent news flow. In our view, the valuation is not obviously compelling given the growth and profitability headwinds we will cover. Moving to financial strength, how solid is the foundation? The Piotrowski F-score, a 9-point accounting-based checklist that flags profitability, leverage, and operating efficiency improvements, comes in at 3 out of 9 for Nike. Scores below 4 are generally associated with deteriorating financial conditions, so this reading warrants caution in our opinion. On the other side of the ledger, the Altman Z-score, a multi-factor model originally designed to estimate bankruptcy risk, where scores above 2.99 are considered safe, registers 3.67, which places Nike firmly in the safe zone. There is no acute solvency concern here. Turning to the balance sheet, the cash-to-debt ratio is 0.72, meaning the company holds 72 cents of cash for every dollar of debt, a modest but manageable coverage level. The current ratio, which measures short-term assets against short-term liabilities, is a healthy 2.14, indicating Nike can comfortably cover its near-term obligations. Debt to equity stands at 0.79, a moderate leverage level for a consumer brand of this scale. Interest coverage data was not available at the time of recording. Taken together, the balance sheet picture is one of structural adequacy, not distress, but not a fortress either. The low Piotrowski score is the flag we would want to see improve before getting constructive on the name. Next up, profitability. Is this business actually making money efficiently? We start with return on invested capital, the return a company generates on all the capital it has deployed, both debt and equity, which registers at 10.07% for Nike. That clears the cost of capital hurdle for most businesses, but it is meaningfully below what we have historically associated with Nike at peak operational efficiency. Gross margin, the percentage of revenue retained after direct production costs, stands at 40.81%, a genuinely strong number that reflects the brand premium Nike commands on its products. But the story deteriorates as we move down the income statement. Operating margin, what remains after all operating expenses including selling, distribution, and administration, compresses to 6.03%. That is a significant gap from gross margin, implying that the cost structure below the gross line is consuming a disproportionate share of revenue. Net margin, the ultimate bottom line profitability measure, falls further to 4.84%. And free cash flow margin, the percentage of revenue that converts to actual distributable cash after capital expenditures, is a thin 2.25%. In our view, this margin stack tells the story of a business navigating elevated costs and potentially overinvesting in a turnaround without yet seeing the operational leverage come through. That is the key dynamic to monitor. Onto growth. Is this business expanding, and at what rate? This is where the fundamental picture becomes most challenging in our assessment. Revenue growth over the trailing 3 years is negative 0.3%. To put that plainly, Nike's top line has been essentially flat to slightly negative over the most recent 3-year window. That is a striking data point for a company that has historically been associated with consistent, compounding revenue growth. Extending the lens to the trailing 5 years, revenue growth improves to 6.2%, which tells us the more recent deterioration represents a deceleration from a stronger prior period rather than a long-standing structural problem. But the directional trend is clearly the wrong one. Book value per share, a measure of the net asset value attributable to shareholders, has also contracted by 2.7% over the trailing 3 years, a signal that the equity base itself is eroding, not compounding. This is a meaningful concern when evaluating long-term value creation. On the more constructive side, Nike does offer a dividend yield of 3.52% at the time of recording, which provides income support for patient holders while waiting for a growth reacceleration. However, a dividend yield becomes considerably less attractive if the earnings base supporting it continues to compress. In our view, the growth score of 3 out of 20 reflects what the data shows: a business in transition that has not yet demonstrated a credible return to volume-driven revenue expansion. Now let's talk smart money. What institutional capital is actually doing with this name? 16 top-tier guru investors currently hold positions in Nike, which tells us this is not a name being abandoned wholesale by sophisticated long-term capital. That said, the nuance in the positioning data is important. Looking at the most notable holders, Hillman Value Fund has Nike at 2.50% of its portfolio with no change in position. Terry Smith of Fundsmith, a manager with a rigorous quality growth mandate, holds 2.15% of his portfolio in Nike, but has reduced his position by 5.86%, which is a signal worth noting given Smith's historically high conviction thresholds. Robert Alstein of Alstein Capital Management holds 1.36% and has added 6.12% to his position, reflecting a more constructive view. Most notably, Bill Nigren of Oakmark Funds has added 72.34% to his position, bringing it to 1.21% of his portfolio, a significant incremental commitment from a value-oriented manager who is clearly seeing a margin of safety opportunity at these price levels. Thomas Gaynor of Markle Group holds a smaller 0.23% allocation with no change. Turning to the broader institutional picture, only 10.4% of 13F filers, institutional investors required to disclose holdings quarterly, are net buyers of Nike, against a threshold of 50% that would indicate a broadly bullish posture. Insider ownership sits at a low 0.99%, meaning management has relatively little skin in the game at current prices. However, insider transactions over the recent 3-month window show 4 buys against 1 sell, which is a modestly constructive signal on balance. And finally, the verdict. Let's bring it all together. On valuation, the Guru Focus value model suggests a meaningful discount to intrinsic value, but a PEG ratio of over 21 and a compressed free cash flow margin make it difficult to argue the stock is cheap on earnings power alone. The setup looks more interesting than compelling, in our view. On financial strength, the Altman Z-score places Nike in safe territory, but the Piotrowski F-score of 3 out of 9 flags deteriorating financial quality that we would want to see stabilize. On profitability, gross margins remain strong at over 40%, but the compression through to operating, net, and free cash flow margins tells a story of a cost structure that has not yet been right-sized for the current revenue environment. On growth, negative 3-year revenue growth and contracting book value are the hardest parts of the thesis to get comfortable with. This is the dimension that needs to turn before the broader story can be rebuilt. On smart money, selective Guru conviction, particularly Bill Nigren's large incremental add, is a legitimate data point, but broader institutional buying, at only 10.4% of 13F filers, suggests the smart money community is not yet moving in unison. The StockTok composite score of 34 out of 100 reflects a business facing genuine headwinds across multiple dimensions simultaneously. Based on what we see, this warrants caution, but it is a name worth monitoring for signs of operational inflection. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Nike Inc. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.